Bloomberg Audio Studios. Podcasts, radio, news.
This is Bloomberg Daybreak Weekend, our global look at the top stories in the coming week from our Daybreak anchors all around the world. Straight ahead on the program, a look ahead to key inflation data in the U.S. and earnings from some of Wall Street's biggest banks. I'm Nathan Hager in Washington.
I'm Caroline Hepker in London, where we're asking if the UK's property market can survive an exodus of the country's wealthiest individuals.
I'm Doug Krisner, looking at the changing trade dynamics for China.
That's all straight ahead on Bloomberg Daybreak Weekend. On Bloomberg 1130 New York, Bloomberg 99.1 Washington, D.C., Bloomberg 92.9 Boston, DAB Digital Radio London, Sirius XM 121, and around the world on BloombergRadio.com and the Bloomberg Business app.
Good day to you. I'm Nathan Hager, and we begin today's program with some key economic data in the U.S. The December Consumer Price Index is due out this Tuesday at 8:30 a.m. Wall Street time. For more on how the inflation data could impact Fed policy moving forward, we're joined by Michael McKee, Bloomberg's international economics and policy correspondent. Thanks for being here with us, Mike. Are we expecting many distortions from this inflation data, given that we've just come out or recently come out of a government shutdown?
Let me sound like an economist and say yes and no.
Thank you.
Two-handed. The problem is we didn't get any October data, and the BLS just assumed all the numbers were zero. And then in November, we didn't get a month-over-month number because there was no October number. And so basically, we're going to have distortions built into the data going into any month for several months. So, yes, there will be distortions in the December data. However, what we will get is a full report on prices in December. It's the comparisons and how much has changed over the month that we're going to have a little trouble parsing out. But we will get complete tables for all of what the BLS surveys in terms of prices for the month.
So our first non-Swiss cheese consumer price index since the shutdown. So what is the expectation as far as what we're going to see when it comes to price pressures here?
Well, the expectations, and because of what I just said, there's not a lot of wide confidence band around this one, but people are thinking we're going to see about a 0.3 increase in both the headline and the core, which is a little hot, but it doesn't really move the year over year on the headline, stays at 2.7%. Core moves up to 2.7% in the economist consensus forecast from 2.6. And even if we do see distortions, the bottom line there is it's not going in the right direction. And that's what would matter to the Fed. And you combine that with the jobs report we got on Friday, which showed weak job creation and the unemployment rate going down, it all would make the case that the Fed doesn't need to cut rates again.
You know, it's interesting because, coming ahead of this consumer price report, we heard just this past week from Fed Governor Stephen Miron on Bloomberg Radio and television saying he sees underlying inflation pretty low compared to where we've seen it on the consumer price data at 2.3%. What's his rationale for that? Does it make sense?
His rationale is there are several aspects to it, one of which is that we're seeing a big productivity gain, and that should mean that there's less inflation, and that if you take out the effect of tariffs, you have less inflation. That's like the old if you don't count food or energy. So there are a number of things that he argues that are maybe plausible but don't make sense at the same time, because it doesn't seem to reflect the real world. It seems to reflect a world that he is hoping would happen, but the numbers haven't proven that out yet.
So where are we seeing price pressures at this point?
We're seeing prices go down in most areas, but there are sort of the fearsome five, as Stephen Stanley of Santander calls them, that includes things like airfares, rents, medical insurance, car insurance, that sort of thing, that fly under the radar but see prices going up on a regular basis. We've seen a food prices, they're continuing to rise, but at a lower rate. It's just that because prices went up a lot, people see every day that they're paying an expensive amount for groceries, and that's one reason that they're unhappy, even if the inflation rate isn't going up as much. One of the things that moves around a lot is used car prices, and the feeling is used car prices from those who track the wholesale numbers might come in a little bit lower, and that might hold down some of the inflation, but you just never know.
Of course, this is a holiday month as well. Are we expecting much holiday impact around what we could see on price pressures?
It is certainly possible because we saw this in November with because you had the Black Friday sales weekend at the end of the month that we saw prices go down as retailers were discounting, and that shows up in the data for consumer goods, toys, things like that. And so there's a very good chance that we would see something like that again in December, but that happens every year. So the BLS would use seasonal adjustment figures to try to take any distortions out of the numbers. The problem is that the seasonal adjustment numbers were distorted by the fact that we didn't have any government reports for a month and a half. So it is possible we see something.
Appreciate this, Mike. As always, that's Michael McKee, international economics and policy correspondent for Bloomberg News. Let's turn our attention to earnings now, because fourth quarter reporting season kicks off in a big way next week when we hear from some of Wall Street's biggest banks. It all starts with J.P. Morgan Chase Tuesday. Then we'll hear from Bank of America, Wells Fargo, and Citigroup on Wednesday. Herman Chan covers all these banks. He's senior banks analyst for Bloomberg Intelligence for banks in the U.S. Herman, jog my memory here, but it feels like the biggest financial firms on Wall Street keep delivering quarter in and quarter out. Is that the case, and is that what we're expecting in the fourth quarter?
Yeah, that's right. The big banks have really driven a lot of the top-line revenue growth for the industry, particularly not only in fee areas like trading and investment banking, but they're growing their balance sheet faster too. So all of that's really driven the outperformance for the biggest banks relative to regional banks and smaller community banks that are publicly traded. So we're talking about the biggest banks, the KBW index up about 16% over the past 3 months. So a lot of enthusiasm for bank shares heading into fourth quarter reporting.
I have to think that a lot of that enthusiasm is driven as well by the way Wall Street ended 2025, a pretty strong rally in the fourth quarter. How could that be reflected in the results that we get from these banks next week?
Yeah, that's right. So recently at an investor conference, the biggest banks like JP Morgan, Bank of America talked up their trading prowess. And for JP Morgan, for example, talking about trading up low teens year over year. Bank of America up high single digits year over year. And so that really bodes well for top line performance. And on the investment banking side, we're seeing more of the same, up low single digits for JP Morgan, flat to modest decline for Bank of America. So really strong results on the capital market side. And looking at industry indicators, loan growth continues. We're seeing some healthy activity across some commercial lending to businesses and large corporate clients. And really the biggest driver for lending in the fourth quarter will be cards, which is seasonally strong, and also lending to non-banks, which has been a growth for the industry throughout 2025. So really positive results on the lending side and also trading and investment banking.
Of course, we're in an environment where the Fed has started cutting interest rates again, coming off 3 straight interest rate cuts to end 2025. What could that mean for net interest income for these banks?
Yeah, that's right. That's something that should be helpful, right? So two aspects for a lower rate environment that should be helpful for banks. One, banks are lowering their deposit costs, their funding costs that help support the balance sheet. So we're seeing on average about 50% of the Fed rate cuts are passed on to your depositors. So that hurts you and me when we have savings at a bank, but that's helpful for banks and how they generate net interest income. Secondarily, we're seeing a steeper yield curve after the rate cuts, so particularly within the belly of the curve. So with the 5-year versus the short-term interest rates, that's actually positive after a long period of negative yield curve on that front. So that's helpful for when banks reprice some of their fixed rate assets. And just big picture, that's helpful for their net interest margins, and we'll see that trickle higher in the fourth quarter and 2026.
And just to hone in on the banks individually, let's talk about JP Morgan Chase, because we've heard recently from CEO Jamie Dimon talking about cockroaches in the credit markets. How are we thinking about JP Morgan's asset quality right now?
Yeah, sure. That's a great question. So the cockroach concern was really within their exposure to Tricolor, which was a subprime lender in autos, and they really stubbed their toe on that one in the third quarter. What's helpful is that overall the economy is really strong, and Tricolor is a very small exposure relative to the $1 trillion asset size that JP Morgan wields. So it's really, in our view, an idiosyncratic one-off type issue for JP Morgan. That's really in the rear view, and commentary from the bank in the fourth quarter seems to indicate that credit quality has been fairly strong, with consumer continue to transact and spend. So healthy consumer activity and really bodes well for credit quality for the fourth quarter.
Now, when it comes to banks like Bank of America and Citigroup, we think of them often as pretty closely tied to the consumer. Mm-hmm. What are we thinking when it comes to the health of the consumer right now? What we could learn from those banks?
Yeah, I would echo what I just said about JP Morgan, where for Bank of America, CEO's been on Bloomberg TV and has said that the consumer is really strong. I think that's really reflective of who they bank, where it's not the customer that's more on the subprime level, where they're more affluent, high net worth type clients on the loan side, right? So there's not a lot of subprime loan exposure for these large banks across the spectrum, and so despite prognostications of a K-shaped economy, the actual credit exposure is on the higher end of the consumer, so that really bodes well.
I really appreciate this, Herman, ahead of a really busy week for you, I know for sure. That's Herman Chan, Senior U.S. Banks Analyst for Bloomberg Intelligence. Coming up on Bloomberg Daybreak Weekend, we'll discuss whether the UK's property market can survive the country's wealthiest individuals leaving. I'm Nathan Hager, and this is Bloomberg. This is Bloomberg Daybreak Weekend, our global look ahead at the top stories for investors in the coming week. I'm Nathan Hager in Washington. Up later in the program, we'll look ahead to the latest trade figures in China. But first, in the coming days, new data will shed light on the state of the UK's housing market. With rising living costs and a proposed new tax to contend with, how will the country's property sector fare in 2026 and the years to come? For more, let's go to London and bring in Bloomberg Daybreak Europe anchor Caroline Hepker.
Nathan, 2025 was filled with headlines about the ultra-wealthy leaving London and other parts of the UK, fleeing wealth taxes and broader policy changes. High-profile exits included those of Checkout.com founder Guillaume Pouzaz and Egypt's second richest man, Nassef Sawiris. The measure that has pushed many to seek new horizons was the Labour government's scrapping of the preferential tax regime for non-domiciled residents that had, for years, allowed them to avoid UK taxes on their overseas earnings for as long as 15 years. In the wake of a range of tax changes in Britain since early 2024, London's property market has slumped. Deals for homes in the capital valued at £5 million, that's $6.7 million or more, fell by more than 35% between August 2024 and August 2025, according to researcher Lonres. In October last year, sales of UK homes worth at least £2 million plunged 13% year on year, according to data from the property website Rightmove. Clementine Monroe is private office advisor at the real estate broker Allsop and Allsop and told Bloomberg that the country's super rich are losing patience with the constantly shifting agenda.
There is a real sense of fatigue amongst the wealthy in the UK. They're used to tax planning, they're used to planning for their futures, and this constant environment that we've had of uncertainty is certainly having a knock-on effect as people start to look to de-sterling their portfolios and move some of that wealth into landscapes like Dubai, where it's much easier to forecast for the future and the tax landscape is so clear.
That was Clementine Monroe from real estate broker Allsop and Allsop speaking to Bloomberg's Jumana Basecci. So, will wealthy Brits continue to depart their native shores? And what could the lasting impact of their decisions be on the UK's property sector? I've been speaking to Bloomberg's real estate reporter Damien Shepherd and our ultra wealth reporter Ben Stupples. Damien, can I just start with you on the data, what we're expecting in terms of UK house prices and what the story, I guess, has been so far?
Yes, we've got some data coming next week from RICS. We basically get the sentiment from property professionals in the UK around the temperature of the UK housing market. Now, they were pretty gloomy last year, particularly in the lead up to the budget, where all of the kite flying and speculation essentially led to people putting their house moves on ice. So it will be really interesting to see how they view the prospects of the UK housing market in 2026. Now, we're finally past that long wait for the budget. My expectation this year is that prices across the country won't move dramatically. I think what we'll see is a big divide in the prospects of London and the rest of the UK, a north-south divide where those living in the north might see their values actually grow a little. What we did see in the budget was a mansion tax on homes valued at £2 million or more. Now, what we could see this year in London is a repricing of up to 5% of those homes in terms of value. So those sitting on property worth £2 million or more might see sort of a quick repricing across this year in London and then see things settle down again. But the prospects for London look far gloomier than the rest of the UK, which I'm sure Ben will tell us a lot more about later on.
Yeah, absolutely. Well, I'll bring you in at this point, Ben, just because we're focused on the property market also as a result of all of the discussion and the concern about the number of people actually leaving the UK, especially on the kind of higher end. How do you think that kind of ties together, I suppose, property and the number of people actually leaving the UK? What do we know?
It's a really interesting question because anecdotally I can say that the non-doms and actually the sources I've lost to amid the UK wealth turmoil, they're not often selling their property. I mean, it turns from a great place to live in central London into actually a pretty good asset to own in your global portfolio, right? If you're an ultra high net worth, owning a bit of London property that often you've coveted for a long time, and you've probably still got a lot of your stuff there, actually you don't want to sell it, especially actually is because the market's pretty subdued. What is interesting is I've seen a couple of billionaires. I mean, these are multi-billionaires. They are exporting a large part of their households. We actually found one example where one of the guys who owns one of the Premier League football clubs, Nassif Sawiris, he turned in previous years. He imported artwork, paintings, books. Imagine the top billionaire elite, what you would have at your disposal, and it's all being exported in 2025 as he builds a new life in Abu Dhabi and in Italy, having lived here for almost a decade. So I think that's maybe a good case study of what we're seeing is, okay, they're not selling their homes, it's a great asset to have, but actually the homes themselves are probably going to look very different going forward. And actually it raises questions. The ancillary services that you have is a big homes. You have staff. You probably have a gardener. You probably have, a driver. Now, I think what we will see more examples of this year is the spillover effects into maybe more normal types of London's economy that serves that sort of segment that we often don't think of. But actually, these are normal people. And I'm going to be very interested to see how that continues to play out this year.
I mean, I suppose it's perhaps, Damien, a little bit hard also to feel sorry maybe for people who have homes that are out of the reach of the majority of sort of ordinary Londoners or Brits. But as we're sort of saying, how important is the luxury end of the market actually to the UK economy? I suppose, why should we care about those sorts of properties?
It's a great question, and people ask me that question a lot when they see my stories. But I think wealth creation is so important for the UK, and with the Labour government, having been seen to be pushing a lot of wealthy individuals away. The more knock-on effects that taxation has on these people and their status in the UK will eventually build up pressure on the government in the long term in terms of the economic advantages that they bring to Great Britain. So, I mean, what Ben mentioned there about how these people aren't actually selling, but just moving away for a little while while they see how the picture in the UK pans out, is kind of similar from the perspective of buy-to-let investors as well. They're under all sorts of pressure from taxation, new regulation, but because the market is so weak in terms of buyers, even if these people did want to sell their property, they'd be selling at such a huge discount that it's keeping transactions low, and we're not actually seeing this exodus in terms of sales of these homes that some might think. So in some ways, the fact that the market has been so weak has prevented us from seeing some of these homes sell that perhaps would have in different circumstances.
Look, historically, it's not unusual for the UK to see boom and bust cycles in the housing market. So I'm kind of curious that with all of the pressures that you've both mentioned, that actually you kind of see quite a bit of stagnation. Is there even an upside maybe that as very sort of inflated, a lot of people would see them as inflated property prices in the southeast of England, if they start to come down overall, that there's a positive story there because actually for younger people or others, they maybe can get on that ladder? Is that another part of the story?
Well, it's a difficult one because, as somebody who just about still considers myself young, house prices are just so high that it makes it incredibly difficult to see any light at the end of the tunnel, even when mortgage rates do come down. But if we're looking at it from a positive perspective, mortgage rates are lower than they were for the past couple of years. The damage that we saw in the years after the mini budget were really quite catastrophic on the mortgage market. We were back to the levels that we were seeing about 15 years ago. So mortgage rates have come down. Affordability is improving. And if you're looking to buy a property, in the north of England, where the market's looking, a lot stronger, people are happier up there when they're viewing their, housing portfolios, the potential for their values to increase. So there is some light at the end of the tunnel in terms of mortgage rates coming down, but we really need to see the actual prices of these homes come down for first-time buyers to really shake off that frustration that they have in getting on the housing ladder.
Yeah, absolutely. You're definitely still young, I'm sure.
Thank you.
Ben, I think it's also fascinating that the last 2, 3, even 4 budgets have been simply so important when it comes to sort of dictating the landscape, not just for property, but for lots of things in the UK. When you're thinking about your reporting, how big a factor is the mansion tax, the non-dom changes? How are you thinking about those now?
To take that in order, the mansion tax, actually, if you're a billionaire, paying a few more £1,000 a year for owning a home you like living in or you still want to hold as an asset, that's not such a big deal. And I spoke to actually a UK billionaire, John Caldwell, on the back of that being announced, and he said, look, that's fine. I'm a UK taxpayer, happy to pay that. The non-dom stuff, however, including with that billionaire I just mentioned, that's a big deal, both for the UK billionaires who see actually a lack of maybe an ecosystem shrinking from their perspective. Their peers aren't here as long as they would otherwise be previously. And the non-dom reforms, that is the big driver. It's twofold. One, it's scrapping the 15-year regime that we had up until April 2025. Now that was long enough, and this is the key thing. It's the time. You could be previously in the UK for 15 years, put down roots here. That's, I think, the key thing here. Why 15 years? It's sort of asking the question why there are 18 holes on a golf course. I'm not exactly sure why the UK settled on that time about a decade ago for previous reform. But the general thinking is that it allowed you to come here and put your kids through school. And by the time you get to 15 years, maybe your kids by then are at a UK university, maybe in Oxbridge, and they're like, you know what, actually, we quite like life in the UK. And what we've done instead now is bring in a 4-year regime. And the UK Treasury, Rachel Reeves said this makes the UK more competitive. But there are growing doubts about that. 4 years, what does that allow you to do, really? Maybe it allows you to take a job if you're a top banker. You could maybe take a C-suite job, turn your team around, and then go back to wherever you've came from. But are you able to put down the same roots you could before? No, you can't in general. So the UK, people have left because of the non-dom regime, and now people are less likely to come and put down roots here. That's the crucial thing. Some people are coming, but they're already, and this is the crucial point, they're already thinking about where they're going to go next. So the UK has gone from being a permanent global wealth hub for a lot of folks in the global ultra wealth community to being what I would maybe term a stepping stone. And that's a significant change.
Thank you so much for being with me. Bloomberg's Ben Stupples and Damien Shepherd. Will the UK's housing sector show shoots of recovery, or has an exodus of the wealthy prompted a longer slump maybe than anticipated? We'll have full coverage and analysis of all that important market data in the coming days on Bloomberg platforms. I'm Caroline Hepker here in London. You can catch us every weekday morning for Bloomberg Daybreak Europe, beginning at 6 a.m. in London. That's 1 a.m. on Wall Street. Nathan.
Thanks, Caroline. And coming up on Bloomberg Daybreak Weekend, we'll discuss what we could expect from trade data in China. I'm Nathan Hager, and this is Bloomberg. This is Bloomberg Daybreak Weekend, our global look ahead at the top stories for investors in the coming week. I'm Nathan Hager in Washington. We'll get the latest trade figures for China in the week ahead. Let's get more on that from Bloomberg's Doug Krisner, host of the Daybreak Asia podcast.
Nathan, these trade figures may provide a sense of how well the Chinese economy is performing, but the more important question seems to center on what geopolitics will do to determine China's future trade relations. Now, that surprise U.S. raid and capture of Venezuelan President Nicolas Maduro has serious implications, not just for rules-based international order, but access to natural resources and supply chains as well. Now, Venezuela had boasted an all-weather strategic partnership with Beijing, and the Chinese were quick to frame this raid as an example of U.S. overreach. For a closer look, I'm joined by Bloomberg's John Liu. He is our chief China correspondent. John joins from our studios in Beijing. Thank you for being here, John, and Happy New Year. There are so many threads to this story, and hopefully we can touch on each, especially the angle on Venezuela and the reaction from Beijing. I'd like to begin with the simmering tensions between China and Japan, since this seemed to be the bigger concern for markets in Asia over the course of the last week. Now, we know this traces back to late last year when newly elected Japanese Prime Minister Takaichi said a Chinese invasion of Taiwan could be deemed a survival-threatening situation. And now it seems as though there's this low-level economic warfare happening. How would you describe the state of affairs?
Yeah, I think China is pulling out all the stops to express how upset it is with what Prime Minister Takaichi said at the end of last year. I think part of that has to do with that she is a new prime minister in Japan, that she has a background of being relatively hawkish when it comes to relationship with China. And it also comes in this context of the Chinese economy not doing great. And so I think that puts more onus on the Chinese government to be strong when it comes to geopolitical issues. And first and foremost in that arena is Taiwan for Beijing. So
Beijing is banning exports of what is being termed dual-use items to Japan that could be used for some sort of military application. What are the economic risk here if this tension becomes a protracted situation?
I think the spectrum of potential outcomes is quite broad because of the vague wording that Beijing is using, this dual-use technologies, because in some sense, almost everything could potentially be dual use. And so I think it gives Beijing the room to either be very tight in terms of how it controls exports or be relatively loose depending on how the situation goes. And I think that injects this uncertainty, which actually right now, like in the immediate aftermath, is probably more troubling for Japanese companies than anything else.
It's very interesting, too, because last week, obviously, we had the visit of South Korean President Lee Jae-myung in Beijing. I think it was his first state visit, although there was a meeting earlier with President Xi in the Republic of Korea, if I'm not mistaken. Talk to me a little bit about what unfolded in this state visit and the significance here of closer ties perhaps between Beijing and Seoul.
Well, from Seoul's perspective, it wants to open up the Chinese market for many of its products, electronics from Samsung, chips from Hynix, all of these things, but especially the ability of Korean cultural exports. So K-pop, for example, Korean TV dramas, for those sorts of things to be able to, again, come into the Chinese market to be sold here, which has been extremely limited for many years, all the way back to maybe a decade ago when Korea agreed to put in the THAAD missile system from the United States. And so that was first and foremost on President Lee's agenda. For Xi Jinping, this was an opportunity to try and get Korea, to try and get Lee onto China's side in terms of that dispute over Taiwan with Japan.
How would you describe the relations between Seoul and Tokyo at the moment, and the extent to which South Korean President Lee has to balance relations with Prime Minister Takaichi while, at the same time, trying to improve relations with Chinese President Xi?
So Korea and Japan have a difficult relationship as well because of the World War II history, Japanese occupation of Korea during and before World War II. But since then, in the post-war World War world, both countries are important key allies of the United States in Asia. They both depend on the United States for security. They both want to do business with China, but they're both also very keen to make sure they're not overly dependent on China. So in that respect, they're in the same position. And so there is a push, there is a motivation for Korea and Japan to be aligned in terms of how they deal with China, just because of the pure size of the Chinese market, the Chinese economy, the Chinese military. But at the same time, Lee is also cognizant of how that relationship plays domestically for him in Korea.
And each of those countries, Japan, South Korea, and China, are all major oil importers. And that kind of takes us to the major story of the last week, the ouster of Nicolas Maduro as leader of Venezuela. China, as we both know, has been the largest buyer of Venezuelan crude. So give me a sense of what the economic ties had been like between these two countries and what we are likely to see going forward in relations between Venezuela and China.
So as you said, Doug, China is the biggest buyer of Venezuelan crude, but Venezuelan crude as a percentage of total Chinese oil imports is relatively small. It's about 4%. And so I think in the immediate aftermath, the implications are not that great because not only does Venezuela account for a relatively small portion of Chinese demand, it's actually been exporting oil that's sitting in tankers off the Chinese coast or off of the coast of various Asian countries waiting to be delivered. So there's a bit of an excess at the moment. I think the more important consideration for China is what it means for the future, because Venezuela does have the world's largest reserves of crude. And so Chinese companies have been very active in Venezuela trying to secure access to that future potential crude. And so what this means for their ability to do that, I think that is the thing Beijing is most concerned about at this moment.
And I'm also curious about what it may mean for China's attempt to do business, not only in Venezuela, but in other countries in South America, whether you're looking to extract natural resources, whether China is looking to make major investments in these countries, or whether China is looking to market Chinese goods. And I'm thinking of EVs and Brazil, for example.
So this is where trade comes into the picture, I think, Doug, because, Chinese exports have been booming in 24 and 25, and they've been booming as Chinese exports to the United States have been falling off a cliff. So the Chinese exports to the United States fell 29% in November. That was the 8th consecutive month that they had fallen by double-digit figures. But still, China's trade surplus is hitting a new record in 2025 of more than $1 trillion. And that's because China's been exporting a lot more stuff to Europe, to Africa, to Asia, but also key here to Latin America. And so I think China is very keen to keep its access to Latin American markets. What Venezuela means for that access, I think, is nuanced, because Venezuela is very different from many of the other markets. It's very different from Brazil, which China has very close relationship with. It's very different from Peru, where China has a very important deep water port that they've built in the recent past. And so whether the rest of Latin America goes the way of Venezuela, I think, is very hard to tell at the moment.
So we're now hearing the Trump administration is demanding that Venezuela reduce its relationship with China. And I'm wondering how this may affect the relationship between Washington and Beijing. These two powerhouses are still involved in many sensitive issues, whether it's trade or Taiwan. And I'm wondering what this will do, the incursion by the U.S. into Venezuela and the removal of Maduro, what this will do to U.S.-China relations.
It's obviously going to inject an additional level of uncertainty. We've seen the reaction from Beijing. It's been very pointed. It's been very strong in its condemnation of the actions in Venezuela. I think that is more Beijing taking advantage of an opportunity to make itself look like the responsible superpower on the planet versus the U.S., which Beijing would say is the less dependable, more irresponsible player on the global stage. But what it means for the bilateral relationship, I think there are so many mutual dependencies and mutual needs. The United States needs China for its rare earths. China needs the U.S. for its export markets. Even though exports have been falling, it's still a huge market for Chinese goods, either directly from China or secondarily rerouted through other countries. The United States is also a place where technology is still coming into China. We've had the NVIDIA H200 chips approved by the Trump administration for export to China. And so I think those dependencies, those mutual needs, they will probably act as a stabilizer. And around that, you're going to have marginal tensions, be it Latin America, be it other parts of the world.
So in the coming week, Canadian Prime Minister Mark Carney will be visiting China. I think it's the first visit to China by a Canadian Prime Minister since 2017. What's his objective here, and what is likely to unfold, do you think?
I expect that Mr. Carney will come here primarily wanting to talk trade, primarily wanting to open up Chinese markets for Canadian energy, Canadian agricultural goods. Those relationships have been really strained. They were especially strained during the Trudeau administration after Canada arrested the CFO of Huawei at the behest of the United States. That plunged the relationship between Canada and China into a really terrible state, and it's still slowly trying to climb back. And I think the change in administration in Canada offers an opportunity now that Prime Minister Carney is in place, Prime Minister Trudeau has left. I think it offers an opportunity for a reset, and I would expect that both sides, both Canada and China, are trying to figure out if they can do that.
Do you think that has the potential to upset the Trump administration?
I think it certainly has the potential, but I would expect that Prime Minister Carney understands quite clearly where the mines are in terms of what he might accidentally step into that sets President Trump off. And I think he will be very mindful and careful of avoiding those. I also do not think, in terms of the relationship that Canada would be open to with China when it comes to investment, when it comes to the military, when it comes to sensitive technologies, I would expect Canada's position to be much more aligned with the United States than how Venezuela was, for example.
John, we'll leave it there. It's always a pleasure. Thank you so very much. John Liu is Bloomberg's chief China correspondent, joining from our studios in Beijing. And I'm Doug Krisner. You can catch us weekdays for the Daybreak Asia podcast. It's available wherever you get your podcast. Nathan?
Thanks, Doug. And that does it for this edition of Bloomberg Daybreak Weekend. Join us again Monday morning at 5 a.m. Wall Street time for the latest on markets overseas and the news you need to start your day. I'm Nathan Hager. Stay with us. Top stories and global business headlines are coming up right now.